I just think the system is rigged for self-employed borrowers.
A lot of cash-heavy business owners can't get approved traditionally, and even some non-traditional or non-QM loans as well.
They're taking that as, I don't qualify with anybody.
You are a business owner in a cash-heavy business, like where you don't put all your deposits into the account every month.
You're not using any traditional tax return income. You're not using any of your bank statements. You're not using any of your assets. Your only qualifying piece of documentation as it pertains to the income piece is a profit and loss statement.
And that really will tell the story of how much income you're actually receiving.
All right, welcome back to another episode of the SCI Mortgage Podcast. We are dedicated to those of you who are self-employed or real estate investors looking to build your portfolios and do not fit inside the traditional lending box. And on today's episode, I am pleased to say that we are welcoming back Dat Win again with the Everyday Lending Group. And we're going to go over another success story, how non-QM financing helped solve a borrower from potentially not qualifying. So welcome back again, brother.
Yeah, thanks for having me on.
Absolutely. So for those of you who haven't listened previously, Dat's the founder of the Everyday Lending Group, where essentially we expedite all of our loans through that. And SCI Mortgage Podcast, we focus mainly on non-QM loan products. So although, we love the non-QM space and that's what this podcast is dedicated to, we do have the ability to do any sort of traditional loan. So shameless plug, if you are a first-time home buyer, you're trying to utilize government down payment assistance from a national level, we'd welcome the opportunity to connect with you. But with that said, this is SCI Mortgage Podcast. So I'm excited to talk about this product today. Before we go into the loan program, I'm curious if you would agree, Dat, that historically speaking, how often do you come in contact with a client where they've gone somewhere else previously, like typically, a big bank, and that bank's told them no, and that essentially they're taking that as, I don't qualify with anybody, and you're having to kind of tell them, no, there actually is lots of different ways you can qualify. So do you find that's like a common theme when you're maybe receiving a referral from one of your realtors or your CPAs or financial advisors, and they're like, hey, this client was told no, is there anything that you can do?
Yeah, it's very common, especially here in Orange County, because as you know, home prices here are a lot higher than national average. So a lot of people here are either self-employed or they diverse their taxes, which is not helpful for someone that's trying to get a loan traditionally, right? Usually they go to their bank first, Chase or Bank of America, like those traditional banks. And then there are also some traditional lenders as well. And, once they hear, okay, you don't qualify, then it's like, okay, well, hey, I don't qualify. I guess I gotta, show more taxes, right? So it's very common, I would say, these days.
Yeah, 100% agree with you. And again, that's just one of the additional reasons why, I moved into the non-QM space and just kind of leaned into that so much because, I work for a big bank for, essentially half of my 21-year career. Right. And, you just don't know. I mean, it wasn't anything against us as loan officers at the bigger banks. Sure. Like, we didn't know that this type of space existed. And then more importantly, in just the last couple of years, and, we've talked about it on other episodes, but it's really blown up. I mean, the non-QM loans, because they're not like the stigma where it's a subprime loan or it's, terrible interest rates. And, if you need this money, like, you better be pretty desperate. Every single day, I'm getting these emails constantly all day long from these hundreds of investors that we work with where they're sharpening their pencils and like, hey, we've got, now our rates are this, now our rates are this. And they're just inching closer and closer to like what a regular conventional loan would be. So, that's fantastic because obviously to your point in Orange County, if you're dealing with first-time home buyers or just, lower down payments, that affordability makes a big difference. And obviously the interest rate's like a major driving factor of that. So, these types of loan products can not only be solutions, but actually be, viable, competitive solutions as far as the rate's concerned.
Yep, I agree. It's definitely growing over the years. I would say it has a good market share now in terms of loans being used for home transactions.
Yeah. So today, I'd love for you to cover for us the profit and loss scenario that we briefly talked about. Is again, this is like a phenomenal product just from a sense of like how limited it is as far as the qualification criteria. And if you can kind of, unpack what your buyer's, scenario and background is
Sure.
and why this profit and loss loan, was a good fit for them.
Yeah. So the profit and loss loan, it's been around for a few years, but definitely in the last, I would say, 2 years, it's gotten a lot more popular over here in Orange County. And the reason for that is because a lot of cash heavy business owners can't get approved traditionally, and even some non-traditional or non-QM loans as well. You had an episode about bank statement loans, right, where they check your deposits for the last 12 months or 24 months and take the average, right? But what if you are a business owner in a cash-heavy business like a nail salon? Right? Where sometimes you just don't put all your deposits into the account every month. You put it into your safe, or that's usually how your business operates.
Your mattress money,
right?
as
Your
they
mattress
say.
money, right? You know what I mean? It's Orange
Yep.
County. Let's just say it, right? A lot of nail salon owners up in here, right?
I mean, I think that's a pretty standard industry term. Everybody knows what mattress money is. Yep.
Yeah, flat out say it. So you can't get qualified with a non-traditional or non-QM product with 12-month bank statements, but what a profit and loss does, it allows you to use your last 12 months profit and loss statement, where the lender is going to take the net income and use that to qualify for you to be approved for a loan, right? And that really will tell the story of how much income you're actually receiving, because it's counting the gross revenue minus the expenses, and then your net, that's your income. So it's not going off of, like, let's just say, what we want to see in deposits, right? It's actually giving the balance sheet and the profit and loss of the actual business currently in the last 12 months. So to me, it's more of an accurate assessment of the business for a lender. So that's the beauty of the profit and loss program, in my opinion. It's predominantly for someone that's just trying to get approved to buy a house, but their cash heavy business, or their business actually does generate a lot of business, but it's difficult for them to show it on paper.
Let's break that down into a couple major bullet points that you just talked about. Number one, you're not using any traditional tax return income. You're not using any of your bank statements. You're not using any of your assets. Your only qualifying piece of documentation as it pertains to the income piece is a profit and loss statement. Another thing worth mentioning is, if you are a traditional business owner and you're going into the bank to get financing, guess what? Even if you had a fantastic year, or the current year that you're in, you're just crushing it as far as deposits are concerned, but you have not filed those returns yet, you can't use that income that's currently available. The bank is only going to use the most recent filed returns. And on top of that, if your business isn't doing as well, and let's say the previous year you did great, now you're kind of tapering off, unfortunately, the bank's going to go with the less of the two situations and average down your income if your profit and loss statement is showing less than the prior average. So this is just one of those perfect examples where I just think the system is rigged for self-employed borrowers as it pertains to, the bigger box banks, right? Because they're going to say, well, you can't use this income because it's not filed yet. But the income is less. Yeah, we're going to use this, and now you make less, right? Like, why does that even exist? So it's huge. I mean, this is a perfect example of why the profit and loss is such a powerful loan, just given the regular terms of, how the lending industry works. So sorry, I had to just kind of jump in there because this product gets me so excited. So tell me a little bit about this client. Is she a nail salon owner, or, and kind of running into the same situation as this?
She's a nail salon owner, right? So obviously they want to get qualified traditionally when they first met with us. So it's okay, let's, take a look at your credit, your income, your assets, the traditional way. Looking at their tax returns and the business tax returns, we looked at it and we're like, well, looks like you've expensed a lot of things off. Your net came out to be, 30,000, right? Now, any smart business owners, of course, their whole goal is to mitigate taxes, right? Just for cash flow and reinvestment purposes, right? But just like any business owner, or just like anybody these days, they find a house they really love and they're like, oh, you know what? We really want to buy this house. We were expecting to buy a house, right? Like, you hear that a lot, right? And then, so at that point, we're like, well, you have two options here. You have to wait until next year and then file your taxes to the appropriate income we need to qualify you traditionally. Or two, I saw that you made, $500,000 in gross revenue last year. What does it look like currently this year? Now, this was, back in October, right? So right now we're in March. So in October, so I was like, okay, well, how much have you generated this year? Like, oh yeah, like well, of course we do well, we just want to mitigate our taxes, just like any business owner, of course.
Yeah, you want to
So
take advantage of
exactly,
legal loopholes, legal tax
exactly.
deductions available to you. Yeah,
Yeah,
as you
exactly.
should.
So, yeah. So I was like, okay, well, then can you show me your 12-month bank deposits? Because that's the first crack at it, right? And that way I can see all the deposits. Yeah, we have about like, ten to $15,000 in deposits, but sometimes I just set it aside and I'd put it all at once. But so if you want me to put all my deposits in now, I could. But I was like, well, if you're cash heavy, can your CPA provide us a 12-month profit and loss statement to show your actual income? And they're like, yeah, like, of course, we'll call our CPA. I was like, yeah, because in order for me to qualify you, your deposit looks like it won't be enough to buy this $1.4 million home. So I need, about $20,000 a month in net income in order to qualify you this way. So then they talked to their CPA, and then their CPA provided them a 12-month profit and loss or P&L. We used that. We sent it to the lender, and the lender reviewed it. They don't require bank statements to match the profit and loss, heads up. But, if you want a better interest rate, then yeah, provide a bank statement. They'll give you a better interest rate because, there's proof that those deposits are there, right?
Yeah, you've got extra compensating factors, right? So it's like you got good credit,
Exactly.
you further verified the income. So yeah, that'll obviously help the rate in
It-
terms of that particular product.
Exactly. I think what a lot of people get confused with when it comes to non-QM or non-traditional loans is that, oh, the rate's a lot higher, right? And I think one thing we all have to understand is that interest rates is all based off of risk, right? So the more you can provide or the higher your credit, the better the interest rate, okay? So when it comes to non-QM, right, the more you can prove and the better your credit, the better the interest rate the lender is willing to give you. So let's just say, for example, I don't want to get sidetracked, but let's just say you have, one of the non-traditional products or non-QM products is no income. You just have to have great credit and tons of reserves, right? And of course, the interest rate is going to be a lot higher because there's no income provided. So going back to the profit and loss, yes, the interest rate is slightly higher. It's actually pretty good these days. And if you can actually provide a bank statement to match the profit and loss, you'll get a prime interest rate that's, I would say, pretty close to what the traditional rates are right now.
Yeah. So I think that's a good point too. Let's talk about the qualification criteria of using the profit and loss loan. So number one, there are programs where you can have, the traditional audited profit and loss, like Dat mentioned, where you're going to have a profit and loss prepared. Your CPA is basically signing off on it. Like, yes, I agree to this profit and loss. But there are products that exist up to certain loan amounts where it's an unaudited profit and loss, where essentially it's self-prepared, right? So to Dat's point, if you go with a self-prepared profit and loss, that is going to be a different set of interest rates. So probably not a long-term loan, but again, it is a vehicle available if you found that perfect home that you're looking to purchase. But aside from that, talk about the down payment. So what is like the typical down payment required on a P&L loan for a purchase if you're using an audited P&L?
Typical 20%.
20%.
Is what you have to put down. Yes, 20%. Now, there are some investors or lenders out there that will allow you to go with 15% down. But like I mentioned, it's all based on risk, right? So now if you put 15% down, now there's more risk for the lender. More risk means higher interest rate, right? To compensate that. So
and you better have a boatload of cash to back that up.
Exactly, right?
Yeah. Any other nuances? I think it's the same in regards of, to Dat's point, again, risk related. If you do a 12-month profit and loss audited versus a 24-month profit and loss audited, you're showing less of an average of income. So that would be another compensating factor that could help further drive the interest rate down. The credit score, the occupancy type still applies, right? So for whatever reason, condo, townhouse, those typically price a little higher because, you have a common wall or more versus a standalone single family residence. But aside from those things, is there any other things that drive the rate or, guidelines to the program?
I would say two. One would be if it's investment or primary, for example. And then the other one would be a business narrative form, just like your standard typical non-QM loan, where if you're a business owner, they want to know how your business operates, the structure. So those are just like the nuances of these type of loans.
Okay, yeah. And what Dat's talking about is it's a standard form that the investor uses where there's different questions that talks about, do you have employees? Do you have a brick and mortar building? Are you just a business that you can run out of your home where there's, limited expenses versus someone that has multiple warehouses? And then the other thing is proving your self-employment. So if you have this audited P&L, do you typically need that additional letter from the CPA talking about the client's business? Like, I've
Right.
been running this business for 2+ years, I'm self-employed, I'm a corporation, whatever that may be.
Right. How many employees? How's your business operating on a day-to-day basis? And certify that you're self-employed for X amount of years. Now, that's if we can't. Typically, lenders will look up your business just to see if it's incorporated and see how long it's been incorporated for. That should be enough. But, in case if you just switch different corporations and just started that new corporation last year, but you had history before, then that's where the CPA would come into play here.
Yeah. Another great feature about this product, and it applies to all other non-QM loans, are if you're using funds from your business account, like you have your business checking account, and that's going to be used for your down payment or closing costs, typically like the conventional lenders have issues with using business funds. So you can do that, but that's just another thing that you would add on to that CPA letter where essentially your CPA is stating that, if any business funds are used for the purchase of this home, it's not going to negatively impact the business. So all of these things are, basically you have two pieces of documentation, right? You got your CPA letter and your audited P&L, and that's it, just to cut right to the chase of, why these products are so powerful as far as the process and just who. For those of you listening who, if you've bought a house and you have a little more complex income and you've gone through the ringer, the loan officers come back to you like a dozen times, thanks for providing this. Now can you give me this and this and this and this? And it's like a never ending rabbit hole. All of these non-QM products are a very straightforward path, very short closing times. You can be aggressive on your offers. There's so many pros to it. Once you just take away the fact if you can fit inside, the credit requirements and you have the down payment, since to Dat's point, you're typically going to need a 20% or greater, to utilize the profit and loss loan. But if you're in a situation to do that, that financing is potentially available to you. So anything else worth mentioning on that product? I think we covered all like the hot topics with regards to the P&L loan, but do you think we left anything out?
I have an example right now, a business owner out in New Jersey who owns a supermarket, and he was trying to get a loan against his property because his property is worth $1 million. It's free and clear, but he's been maxing out all his credit cards for supplies and whatnot. And, he had some families, personal things going on. So he's definitely over leveraged. So now he's paying, $2,500 in just credit card interest right now as a business owner, right? And then so two things happened. One is he didn't show enough income on his taxes. The second part is that since he used a lot of his credit cards, now his credit went from 740 down to like a 650, right? So now you got a couple things working against you. So when he reached out to me, I was like, well, let me take a look at it, right? And of course, anybody in that situation, they're like, well, let me see what the interest looks like, right? And the interest was like 7%. And he was like, well, 7%. And I was like, yes, 7%. But if you look at all the credit cards that you're paying right now, what does that look like? Right?
Just 20s and 30%. And
I think
your credit score is, taking a beating.
Yeah. So, and I broke it down to him. I'm like, well, you got to look at this overall as a whole short term and long term here, right? All your credit cards right now, you're paying 15% to 20% just interest only, right? Let's take a look at this here, right? Yes, 7%. I agree with you. Yeah, it's relatively a little bit higher, right? But you understand your credit score, right? Understand the loan program that we're doing here for you, right? But if you were to put this all on a monthly expense compared to your credit card's monthly expense, which one makes more sense here, right? Because this will take care of all your credit cards. Your principal and interest came out to be like $1,700 a month, right? On a 30-year fix. And then on top of that, now what's going to happen, I agree with you. Let's just say, call it like it is. You don't like the interest rate, fine. But in about 1 year, once you pay off all these credit cards, you have a little bit extra money for reserves, you get your back on your feet, right? You take care of your personal things that you need to take care of, right? Then what's going to happen is that your credit should go back to where it was before all this, which was, you said, 740, right? So given that, then at that time, you can then refinance into a lower rate for your mortgage, right? And if you wanted to, then you can also pay taxes on your next year's tax returns. And then that way you can get the traditional mortgage and get you the best interest rate possible, right? Solely up to you, right?
Yeah. And honestly, like, we all run into that from time to time where, the rate may be higher than what our client's expecting, but it's important that we also help paint the picture exactly like you did, because at the end of the day, everything comes down to like math. I mean, it's basic math. So what are your credit card payments? Those payments are amortized over 30 years. So if you want to figure out what your rate is, just look at your minimum payment over 30 years. It's going to tell you based on your balance, this is what you're paying on your credit cards. And I'd be willing to bet it's, upwards of 20+% until I think they're passing that law where they're trying to say that max credit card interest rates are 10%, but that's still 3% higher than DAT's loan.
The
But
CEO.
the other thing is,
Sorry.
in full disclaimer, Dat and I are not licensed CPAs by any means, so consult a tax professional. However, with that said, Dat gave his client a first mortgage. Well, that's tax deductible mortgage interest now, which your credit card interest is not tax deductible, right? So, that's further reducing the amount of, technical payments that you're making if you need that additional deduction. So, I think that's a great example of how a cash out refinance using a P&L loan. I confidently think that person's now in a better position. And yes, I agree with you. His score is likely to increase dramatically because he's just over leveraged, right? Yeah. Nowadays, if you're like over 25% of your revolving available credit, it can start to hurt your credit score. Once you get over 50, you'll definitely start losing points, right? Because and again, I'm not a financial expert, but typically it's better to have, rather than one credit card maxed out, you're better off having like 3 credit cards with the same amount of money spread out over that, because it's on credit. As far as the digital credit world's concerned, that's just showing you that you have all this available credit. Now you're at 25% of your credit versus, 100% of one card, thinking like, oh, I don't want to open a bunch of cards up. So with that said, don't go open a bunch of cards up. I mean, it doesn't look good either having like 20 credit cards or whatever, but in an isolated example, it's leveraging the debt to your advantage. So awesome. Yeah. Well, I think that's a perfect example then for us to end on for this episode about the profit and loss loan, how it can apply to a purchase transaction or a refinance as a great solution in the non-QM space. And thank you again, Dat, for being a part of, this community here with us. I'm glad you're able to hop on, and we'll definitely continue to do these success stories with these loan products in future episodes to come. Yeah. And if you want additional information regarding these loan products, feel free to head over to scimortgage.com where you can find our contact information, or you can go to the everydaylendinggroup.com where you can get in touch with Dat in regards to all the other traditional products that are available for the conventional space, government, first-time home buyer, and so on. So thank you so much, brother. I appreciate you, man. And until then, let your money work smarter, not harder. We'll see ya.